All right, welcome back to Outsourced Alpha. Excited to keep these rolling, and I'm especially excited to have today's guest because I have been nerding out on fund finance reports. You see a number of these in the market, like Haynes Boone, Akin Gump, Mofo. They put out these annual summaries, and look, the headline number across fund finance is staggering. From what I read anyway, the outstanding fund finance market just crossed over $1 trillion. So depending on who you ask, that could be upwards of 1.75 trillion in aggregate. And that sounds ostensibly like everything is going great. But what I wanted to do today is get past the number and tell a better story from somebody who's been in the trenches for decades. Now, 2026 is not a year of new product development in fund finance. So going through a few basics, I believe it's a year of structural stress. You look at subscription lines, which we'll talk more about. Basically table stakes now, and many report that close to all lenders closed on at least one of those in 2025. Fine. Then you have NAV lending that's hitting a record, which nearly 13 billion in new fund closes last year alone tells everybody that the market is getting bigger and bigger. But the questions, the underwriting standards are getting harder, and there are certain banks out on the market that have been tightening underwriting standards and pulling back on commitments because the reassessment of collateral values tells them to do that. Then you have PIK toggles where borrowers are deferring cash interest instead of paying it. That's showing up more, and it could be a sign of the times, but time will tell. And last but not least, you have this alternative capital, insurance capital, private lending, becoming a major force in the market and how facilities get structured, reshaping covenants. And I'm not sure GPs fully understand the whole of it and how to understand a traditional bank versus a private lender versus insurance capital. So Mark has been in the middle of all of this since 1997. So let's start here with a quick introduction, Mark, a little bit about your background and what you're up to today.
Yeah, thanks, Derek. So my background, I have been with the bank for 29 years. Well, at least I started 29 years ago in the summer of 1997. So that is a long time to be with a firm. I don't claim all 29 years. I was gone for about 5 of those, but I've been back for the last 20. 17 of those with SVB and the last 3 with First Citizens, who acquired us in 2023. So, and then, roughly half that time has been in fund banking as opposed to any other type of corporate banking or working with the innovation economy, which Silicon Valley Bank originally did. So that's most of the background. It's really been very, kind of laser focused on fund finance for the most part.
Very cool. I think before we get in, because we're going to talk about a number of these product types quite a bit, I wanted to define them for the audience. And we're mostly going to be discussing sublines, NAV lending, and then you have GP financing. So the first of which is the subscription credit line, otherwise referred to as sublines. And the simplest example of this is a private equity firm finds a deal. They need to wire $50 million in 2 days. The LPs technically have capital committed, but calling that's going to take another week and a half. So a subline in that case is going to cover the wire now. The fund calls the LP capital, pays the line back, and there's no difference to the LP. So that can go to 500 to 700 basis points above SOFR, depending on how you ask. Then you have NAV lending, which is effectively a loan secured against the net asset value, as you might assume, of the fund's portfolio. So in that case, a fund is in year 8, say, and a portfolio is worth 500 million, but everything's tied up in illiquid positions. A NAV loan lets the GP borrow against that value to fund follow-on investments, return LP capital without having to sell anything. Now you see alternatives being things like continuation vehicles, but we can talk about that later. Then in the fastest growing area of the market, you have just traditional leverage GP financing where a GP wants to put down 10 million of their own money into the fund, which is the GP commit. Doesn't have it liquid, they can borrow against the management company or future carry to fund it. Obviously, this is higher risk and the underwriting is much more idiosyncratic, but it keeps their skin in the game and keeps everything moving. So as we talk about the products, I would basically go back to the point that the most common product in the market is subscription credit lines. NAV lending is becoming more popular along the lines of mid-market GPs. And then GP financing is up and down depending on who the actual person is at the GP. So just starting there. So at Juniper Square, and then we'll go Mark to you in a second, we see GPs take on sublines at formation, maybe because their lawyer just said it's standard, but I'm not sure that most can explain things like covenant risk if you handed them the term sheet and put them in front of them. So let's start with the basics. Why did GPs take on debt? And beyond the official answer of bridging capital calls and smoothing distributions, what do you believe the real driver is in 2026?
Yeah, I mean, that's a loaded question. And I don't think it's 2026 specific, except for maybe some of those additional leverage facilities you spoke of. The true reason behind these, 20 years ago, 30 years ago is not much different than today. It really is to smooth out the capital call. It really is to, not be calling from your LPs constantly. If you're a VC and you're making a lot of little capital calls, or you're making a lot of little investments and follow-ons, you're going to want to, build it up and then maybe pay it off quarterly. If you're a private equity firm, you're going to want to, maybe fund an acquisition by acquisition, or again, build it up for 6 months to a year. They typically keep it out longer as registered investment advisors, and then pay it off. And it not only smooths it out for the LPs, it smooths it out for the firms themselves. They just don't have, and it works different for real estate funds, for private equity funds, for fund of funds. I mean, you can imagine how many capital calls a fund of funds would make if they called capital every time they got a capital call from their underlying GPs. So, there's a myriad of reasons for why firms have a capital call line or subscription line, as you called it. And I don't think the purpose has changed too much over time. What I do think has changed is the duration of the outstandings. And, maybe that's for a little IRR boost, but, that's not going to work for venture or growth where, they keep it out for, 1 month, 3 months, something like that. Maybe it works a little bit more on private equity where it's out for a year and you're only holding the asset for 3 years. That could certainly help an IRR, not your MOIC, but it will help IRR. Not going to work on the other end of the spectrum.
Very well. And look, I'm not sure that debt is inherently good or bad. It certainly depends, and it's a tool. So let's walk through a specific example without going into names or details too excessively on a GP that used debt intelligently, and then maybe give us an example of one where it perhaps hurt them or set them up for failure down the line.
Sure. Yeah. Look, as far as subscription lines, it's kind of hard to hurt yourself on a subscription line. The only thing to consider on those is they are technically revolvers, right? Those are not term loans where you're taking all the capital in and then paying it off over time. It's really, it has its limited partnership agreement directive. So if you're allowed to take it for 90 days, you got to pay it off within 90 days. If you can take it for a year, you got to pay it off in a year. So it is revolving. I think firms could get into trouble if they tried to make their subscription line act like a NAV loan, if they use their subscription line to fund GP commitments, if they use their subscription line for things that aren't meant to revolve. I guess you could get into trouble that way. We certainly haven't seen it very often. It's pretty rare over the many years. There's only been an instance or two where, they get into that position where maybe GPs have to step in because they used it for an instance that was not for a revolving purpose. The other loans are certainly meant for longer duration. And that's just sublines. If you talk about NAV loans can be used in a couple different ways. One being really proactive, where you're using the capital in the cap stack. Like you are expecting to use a NAV loan at the middle to end of a fund's life cycle for an add-on or an accretive investment to the existing portfolio. You either don't want to call more equity for that, or you can't because it's not there and available, and you don't have maybe recyclable or recallable capital. But that can be done in a proactive way and be really accretive to the fund. There are also times that it's super defensive. They just got themselves in a bind and they're going to get crammed down on some cap table if they don't contribute to this next round, or they're trying to put an asset up for sale and they have this other asset they'd like to acquire and simply don't have a method with which to do it. If they, try to do a NAV loan really quick, I think it's going to be, they're going to run into some problems. There's a lot more to the underwriting and to the due diligence for a NAV loan, to take those risks.
Sure. And that begs the question for me. That's a really good transition into a next question I have, which is this notion of capital structure as a strategy. Because a lot of GPs up front during formation, as I noted, are basically just following the direction of their fund formation attorney. Although I think to avoid things like capital calls coming at a really bad time or having a tough conversation on a covenant breach, a lot of that can be avoided by having a really good structure and playbook from day one. So how do you advise somebody during the formation phase of putting together a really good capital structure that also shows up as a strategy down the line?
Yeah, that's a good question. I don't think there's any magic to the private equity, setup and fund formation. Clearly, they have been getting more complicated over the last 20 years. A lot of that is due to the international focus, either of the LPs or the investments themselves. And that's added a lot of complexity on the fund formation side. But as far as sort of use of capital and capital stack goes, the one thing I'd recommend is that you talk to the Fund Formation Council about allowing for types of debt, right? You allow for a capital call line and you maximize the amount of days outstanding that you can have. You allow for the things like assignment of the capital, assignment of the LP's interest so that you can, have a subscription line without any friction. You allow for a NAV loan. And maybe it's governed. It should be like on the capital call lines, it should be governed by how many days outstanding. It should be governed by a percentage of the fund size. On the NAV side, again, you allow for that to be part of the LPA. It is actually not in most kind of pre-2023, 4, 5 LPAs. It's not even contemplated. Sometimes it's a gray area and people do it. Other times it's just, it's just really not contemplated. So putting it in there avoids the last minute, got to go out to the LPs, got to go out to the LPAC, got to amend the LPA, to allow for something. Because most of the time you're looking at these things because you have something you want to acquire. And that just adds a lot of time and maybe friction with LPs. And again, that's for kind of more traditional private equity, regardless of the underlying investment thesis. When it comes to like secondaries funds, this is already a part of their capital stack. Secondaries funds use NAV loans on the regular course of business. When they acquire, an LP's interest in multiple GP's funds, they typically do it with a combination of called capital, of equity and debt. And then that's a product that's been around for a while. Private credit funds use leverage all the time. They pool their loans together and get leverage lines associated with that. So kind of depends on where we're talking on the spectrum of private equity, because I kind of put them all into private equity, even private credit and secondaries and venture capital. But they've all got their different use cases and different sort of structural limitations.
Yeah, before we go on, you mentioned private credit. I think a lot of people have a misconception that private credit is directly competing with big money center banks and big fund finance teams. I guess, would you agree that that is nothing to consider at all and that they're not competing, or is there something else there that we should be thinking about?
Yeah, I don't think that private credit funds are competing with banking fund finance. I don't see private credit trying to put in a capital call line, but they do. There are specific private credit funds that do NAV loans, and many have started since 2022, 2023, maybe a little bit before that. And there are some that have been around for longer, but the bulk of them, kind of popped up over the last 5 years. And they, specifically to do NAV loans to private equity funds. So that in that case, they compete. On the other side of the spectrum, they do not. It's again, because it's a revolver, and that's not really, I don't think, enticing to a private credit fund. I think that commercial banks on the regular, whether they're just lending to a widget company or they're lending to a technology company or a piece of real estate or infrastructure, whatever it may be, they may compete with private credit. But on the fund finance side, it's probably narrowed down to specifically NAV loans to private equity firms.
Fair enough. Yeah, I would agree with you on that. And we talked about LP behavior. One of the behaviors we've seen across LPs, at least what they're saying in public, is that they're much more conscious of leverage post 2023. And this is not just private credit. This is private equity as an asset class. Do you think the use of leverage changes the decision to allocate as an LP into a fund, or are they more or less still looking at track record and investment thesis and everything that's been important for the last few decades, more importantly?
Yeah, I mean, I think the more sophisticated LPs, your pensions, foundations, endowments, some of the really large family offices, insurance, right? They're underwriting like they used to underwrite, which is a manager and history that the manager has, and maybe attribution for managers if they're spinning into a new fund, and obviously, just track record. A lot of it, I think, is more on investment thesis and fund size when they're allocating, depending on the dollars that they put to use. So some of the larger LPs, in the larger funds, because, their minimum check size is 100 million. They're not going to go into a $200 million fund. The use of leverage, I think, really, a capital call line is not really leverage. A capital call line is a bridge loan. A NAV loan can be considered the use of leverage. LPs sometimes have some consternation about NAV loans, but I think most of the time it's just a lack of understanding or I should call it the lack of communication between the GP and the LP about why they want to use leverage for that particular instance. Because, 9 times out of 10, it's for an accretive purpose. They're acquiring another company or making an add-on or, acquiring more of that company, versus like taking out a NAV loan to do a LP distribution. That is super rare. I've seen it 0 times in in all the ones that we have done here, but it does get talked about. So, and then again, when you go to secondaries funds, right, there's an expectation they're using leverage, and obviously that's backed by LPs. Private credit, there's an expectation that they either have a leveraged sleeve or an unleveraged sleeve. And so I think as an LP, going into it, whether or not there's leverage or not. Probably not a capital call line. I think that just is standard across the board because, again, I don't consider it leverage, but the others are probably specific to the fund. I don't think LPs are making decisions necessarily based on that.
Sure. And yeah, the market has changed in how LPs see the market, how GPs put together their capital strategy. It does change with cycles. It does change with market dynamics. And look, you've been doing this a long time. So you've been through the vicissitudes of fund finance, the market, and life in general. What has changed since, say, 2023, when everybody was looking to re-underwrite risk and look at the bank a little bit more closely when they were looking to partner with somebody? A lot of people might assume that a lot has changed, but I wonder if you would disagree with me on that.
Yeah, I mean, the answer is both. A lot's changed and a lot has stayed the same. What has stayed the same is like, our team. We still do all the same things. We still have a huge book with 2,500 clients on the capital call side and the NAV side. So, that stuff hasn't changed. I think we're still underwriting the same way. We still look to the LPs on the capital call side. We still look to the assets on the NAV side, and it's very manager specific, and we underwrite to those managers as well. The parts that have changed, I think, are new entrants into the fund finance, right? I mean, there is almost every bank out there will have some kind of a solution, whether or not it's sort of customized or bespoke as a one-off because they know a GP or they know a portfolio company. They may put in a capital call line or do a NAV loan, and it's very one-off. And you may get odd terms in those scenarios because I think the bank that's underwriting, may not really understand it or understand the whole spectrum and the whole ecosystem of what's going on. So, that's what I think has changed. And it's where I think GPs need to be really cognizant of who their partner is. You're going to want ones that have not gone in and out and in and out, depending on market conditions. Find a banking partner that's been doing it for a long time. And that way you get consistency and a way to de-risk, the fund banking operations and your firm's operations is to have a solid, banking platform, a solid banking team.
Yeah. So what are some questions that GP can be asking up front to understand if they're getting fair terms, if they're going to have a good relationship management structure? Like if they're doing due diligence on a bunch of banks right now, where would they start, in your opinion?
Yeah, well, I mean, the COIs in the private equity industry, the centers of influence, right? Like yourself, the fund admin world, the fund formation council world, their placement agent, if they have one, those are good barometers to like what banks to use and why, especially on the fund admin side. To be honest, the fund admin is the one that's probably on the banking platform. And so they'll know what banking platform matters. Whether or not it was built for PE or if it was built for individuals. Like our platform was built for fund banking, is not part of an investment bank that's just doing this to try to get, the portfolio companies when they go public. We are not built on a private bank where really they're doing this as an ancillary product because they want the GP's private banking. I mean, we have those things, but we don't start with them. So fund admins are real good in that they are going to understand the banking platform and can help a GP, again, navigate how to de-risk their operations. Having a really strong CFO or fund admin and fund finance team is going to help the GP, right? Because again, those are the folks that are going to be on the banking platforms. When it comes to fund formation counsel, I think they're a good barometer too, because they see terms, maybe not the fund formation team, but the other teams that they're at that law firm that maybe sit on the other side of debt facilities with private equity firms. And so they can sort of see what terms are market and fair. They'll know when a firm is getting a way too good of a deal or a really bad deal. And typically the way too good of a deal is because they're making the banking decision on maybe a transaction as opposed to a long-term relationship. They're making the banking decision for some personal reason, the general partner, I'm saying. And, maybe those don't have really good long-term prospects as far as, a partnership when the market does go awry or you need something last minute or you need advice on how to talk to the LPs about amending an LPA, just really understanding the complex structures of where funds have come today.
Yeah, and beyond just choosing a good bank, we've seen this noticeable rise of non-bank lenders over the years, whether it's insurance capital, whether it's private lending, hard money lending, however you want to define it. A lot of that has become more mainstream and institutional. So what are some of the questions or considerations or red flags the GP should be looking out for when it comes to non-bank lending so they don't actually get into bed with the wrong provider in that sense?
Yeah, that's a good question and a loaded question for the GPs because, I think a lot of times it is thought of a bit transactional. Especially when you think of fund banking and maybe subscription lines as more of a commodity. But I think that's where you run into a trap, right? You end up with either banks that are coming in and out of the market. And so you don't know what's going to happen in 3 years. New upstart banks that are trying to do this, they don't have the platform for it. Larger institutions that you're going to be just too small for. And you're not going to get the love that you think you're going to get. And so that's the part of banking that I think, makes a difference. As far as the other lenders, like private credit coming into this, again, it's really only on the NAV side of the house. And so if you're looking at terms between a private credit fund and a bank, I think you need to consider where their cost of capital is coming from. And so private credit typically has a higher cost of capital. They may have looser structures because they have to charge more to get to the return profile that they need for their LPs. Banks may have, a better pricing solution, but have a couple more guardrails around, what you can and can't do, or size versus fund size, or size versus loan to value. And then, last entrance into it with insurance, it's relatively new. It's kind of coming on hard and fast, but a lot of times it's insurance companies backing private credit. And so their cost of capital comes down a little bit, or it's insurance companies looking to, be in a securitization with a bank to provide some relief for a bank, that would like to do more subscription lines. I think that's really few and far between at this point in the dollars. While they may be in the hundreds of millions, this is a multi-billion-dollar industry. So it's kind of irrelevant right now. I think it will become more relevant later as some of these lending institutions sort of hit their caps, if you will, on how much they want to lend into this. That's, again, why it matters to have a firm that, where our global fund banking part of First Citizens, part of SVB, is a standalone team. Right? It's not part of the private bank, as I mentioned. It's not part of an investment bank. It's a standalone group within First Citizens. So we don't have those kind of guardrails that I think that others, will run into. So that's something to consider.
Yeah, there's a lot to consider. And we have a lot of mutual clients with you guys, ranging from emerging managers all the way through institutional funds. What is a good heuristic, or how should an emerging manager think about fund finance relative to their peers that are in the institutional fund land? And what are the major differences in how they work with a bank like yourself?
Yeah, it's probably coming down to complexity, right? An emerging manager is probably about it. It's probably coming across as the most basic sort of GP LP relationship. And, I would imagine that their limited partnership agreement and things like that are more basic. So you don't need as much. I still think you want to go with the right fund admin and the right fund formation counsel and the right banking partner at the beginning, because otherwise you will be switching. It really comes down to, again, like I said, complexity. So the emerging managers, they really just need a bank that has a platform that understands them, that knows what the GPLP relationship is all about, understands the importance of wires, coming in and coming out and getting that right. And then working, with their limited partners, if there's a distribution, things like that. So once you get to the more complex institutional managers, they're going to need a platform that can support that kind of complexity, whether it's, understanding the international scope and, Lux domiciles or Cayman or, whatever it may be, international investments, exits that come from international companies. So I really think it's just a form of complexity. They're pretty basic at the beginning. And when you get into the more complex, more institutional funds, it comes down to their structural organization, right? It's a lot more complex. They have a lot more boxes in their organizational chart than an emerging manager. And, banks need to understand that and understand the flow of funds and, which entities are getting what and when through all the different jurisdictions. So again, the difference between emerging manager and the large institutional funds is complexity and, making sure you have a partner that can discern between the two and handle both.
Right on. Well, Mark, you've been in the industry for 30 years. You've seen a global financial crisis in 2008. You've seen a pandemic. You've been to 2023. What are you most excited about in fund finance over the next few years? And what do you want to share with the audience as some parting words?
Yeah, I just think the way it's evolved over time, right? In the early 2000s, you had, really small capital call lines that were paid back almost immediately. And it was just sort of rinse and repeat. You fast forward it to today, and you have institutions like ours that really work with a fund over its entire life cycle. And so we've discussed a lot of those types of debt facilities, but also there's all the treasury that goes along with it. There's the foreign exchange that goes along with it. There's the private banking and wealth that goes along with it. There's the portfolio company support that goes along with it. And, I think you look for institutions that have dedicated teams for all of those aspects. And so, like you mentioned back in the day, 30 years ago, we were not as complex. And so we have grown up with all these funds and have reacted to some of the changes and have foreseen some of the changes and put stuff in place ahead of time. And, that can be seen on a fund sort of banking platform that's built for this, dedicated teams and all of those other little ancillary things that I mentioned, from deposit and treasury and foreign exchange and letters of credit and GP lending, everything in between. And so I think that's what's exciting about it. If I can geek out on banking, if that's exciting, these delicate banker hands get excited about that kind of thing. And so it's really just the complexity and the fact that we've grown up with it, and it almost feels the same because we still offer everything that's available out there, and I like it. I see a big bright future for it. It's only getting bigger, and it's good to be a player within it.
Good stuff. And Mark, if anybody wants to learn more about your platform and if you can be of assistance, how can they find you guys, and what's the best way to get in touch?
Yeah, the best way to get in touch is to Google us. You can email me, mark.thylin@firstcitizens.com. Works real well. We have reports out there. Like, we put out a quarterly global fund banking outlook report, and it's great. It goes into all the different aspects of fund banking, LP thoughts, GP thoughts, exits, within private equity and venture. And it's all sourced through, sort of the SVB First Citizens proprietary, platform. And then, where we want to enhance it, use some public information. But, those are the best ways to get a hold of us, or just to get onto the banking platform and look me up. Send me an email.
Sounds good. And we'll link that report to anybody interested. And if you want to get in touch with Mark and for some reason you can't find them, just ask me. I'm happy to make the introduction. Mark, thank you so much. Hope you enjoy the rest of your week. And this has been a pleasure.
Great. Thank you, Derek. Appreciate it.